Is there more downside for Bitcoin ahead of us? Will we see Bitcoin drop below $20,000 again? In today's episode of Crypto Over Coffee, I'll walk you through two warning signs of turbulence ahead for Bitcoin and crypto, as well as my thoughts on what comes next. So grab yourself a coffee, hit the subscribe button, and stick around for the whole episode to get all the details that we have in store today. Now, the month of April saw Bitcoin break back above $30,000 for the first time since last year, up nearly 100% from the 16K lows in late 2022. However, the fervor for Bitcoin and crypto has seemed to slow down a bit in May, with Bitcoin ranging just above the mid $20,000 range. So we're in the $26,000, $27,000 range these days. Many believe that Bitcoin's at the start of a big bull market run, but there are warning signs that the ride to the next bull run may be far from painless. And the biggest concern right now is global liquidity, which in many ways is responsible for the resurgence of Bitcoin, crypto, and stocks in 2023 so far, in my opinion. I talked a lot about this in last week's episode, so you can check that out after you're done here if you're interested in that. Anyway, global liquidity is essentially a measure of the availability of cash and credit that can flow into risk assets like crypto and stocks, for example. And there's a looming threat to global liquidity right now, the US debt ceiling. The United States legislature is currently locked in debate about how to meet its debt obligations, including raising the debt ceiling and potentially issuing some form of bond to help pay for its debt obligations, in the short term. Now, depending on the nature of the deal that's done on the debt ceiling, you could see a significant drain on global liquidity as a result, which could cast a much grimmer picture for risk assets like Bitcoin, like crypto, like stocks. Even worse still, if an unprecedented breach of the debt ceiling were to occur and no deal is reached to raise or suspend the limits in place, the results would likely be catastrophic for risk asset markets along with all forms of credit in the US. There are proponents of the idea that a US debt default would be bullish for Bitcoin, but I don't believe that that's true. You need capital inflow to support price growth in Bitcoin, and an event that crunches liquidity and sends a major economy into a guaranteed recession is far from a guarantee of capital inflow, despite the fact that long-term capital flight to Bitcoin will likely continue. For now, we're going to have to wait and see whether a deal gets done before the first potential deadline of June 1st, but I'm watching this one really closely as I mull my options on how to trade Bitcoin in the months ahead. If there is a major liquidity crunch, we could very well see Bitcoin touching the low 20Ks again, or we see capital flight and it goes up. My money is on low 20Ks if we do have a major calamity in the market. However, there's another wild card in this whole equation, and that's a longer term area that we should watch, and that's Tether. Now, Tether is the largest US dollar stablecoin, and they recently started investing a portion of net profits from operations into Bitcoin to bolster the reserves that reportedly back its stablecoin. Of course, I say reportedly because there's been so much controversy and speculation over the legitimacy of Tether's audit reports and their backing and reserves. A recent report about Tether showed that over $1.5 billion worth of Bitcoin's already in reserve at Tether, and that they have plans to invest up to $75 million a month in Bitcoin to bolster those reserves. And at face value, people think this is great for Bitcoin. It's steady monthly demand and some reasonable volume. However, I think it could pose just as much risk than it does potential reward. For one, $75 million a month sounds like a lot, but in reality, it's a small chunk compared to the daily Bitcoin trading volume of 7 to 9 billion, even during this rough patch for crypto. Secondly, with Tether set to outpace MicroStrategy's purchase of Bitcoin and become the largest Bitcoin holder if they keep on buying like this, don't you feel a little uneasy about that type of concentration of supply in one big opaque entity? I mean, furthermore, with questions around Tether's reserves, accounting, and all the controversy surrounding this major pillar of crypto, doesn't that raise a few warning flags? I mean, we all remember the last time a prominent US dollar stablecoin tried to stabilize itself and earn investor confidence with a massive war chest of Bitcoin. UST, the defunct Terra stablecoin, had amassed a $3 billion reserve of Bitcoin to protect its peg, all of which was dumped in a short period of time as UST imploded before our eyes. And while this may seem like an old man yells at the sky sort of thing, It doesn't thrill me to see a stablecoin issuer that's shrouded in mystery and opacity loading up billions and billions of dollars of Bitcoin, because I don't know what happens if things go south for them. I suppose that Tether faltering would be a much bigger event than, and a far greater threat to Bitcoin than just market dumping billions of dollars of coins. But still, all of this is weighing on my mind. It's worth considering. I'm not a fan of the idea of big organizations owning huge amounts of Bitcoin supply because it centralizes the risk of forced selling. It's just not worth it. However, there is a silver lining here because Bitcoin just crossed a major milestone. That's a positive counterpoint to juggernaut holders like MicroStrategy and Tether on the rise. The total number of Bitcoin wallets holding one or more whole BTC crossed 1 million, which is a huge milestone for Bitcoin. This signals that the field of longer-term holders in Bitcoin is still growing and that the individual is not being left behind in Bitcoin ownership as the growing trend of behemoth whale investors chomping up supply continues. So if you ask me for my prediction on what's to come next for Bitcoin, my educated guess is that the US does not default, a deal is reached on raising or suspending the debt ceiling, and we see some impact to global liquidity that drags down risk asset markets, particularly if another rate hike is announced in June, which I think is kind of a 50-50 proposition. In those cases, I think it's feasible to see Bitcoin dip below 25,000, if not lower, before moving back upwards when macroeconomic conditions stabilize or the next macroeconomic policy shift starts to happen and the inevitable liquidity injections come again, and we'll be off to the races. But speaking of stabilizing, Ethereum gas fees seem to be pretty stable. And when I say stable, I mean consistently way too freaking high. Meme coin mania has seen demand for block space exceedingly high for a bear market period in particular. That said, the need for layer 2 networks is undeniable in the Ethereum space, and one of the most notable optimistic rollup layer 2s, Optimism, is about to get a major upgrade on June 6, 2023. This upgrade, dubbed Bedrock, was voted on by the Optimism community nearly unanimously back in April, and from what I've been able to find online and all the reading I've done, the upgrade scope seems to be really, really wide. This is a foundational upgrade that touches pretty much every layer of the stack, and the team calls it a complete rewrite that will bring significant performance and functionality expansion, and its implementation echoes that of the Ethereum implementation post-merge from an architecture perspective. It does away with this unified monolithic stack in favor of a modular multi-layer stack that separates the core functions of the Optimism network into three: the settlement layer, execution layer, and consensus layer. Again, much like the Ethereum one that has the execution and consensus layer now separated. This upgrade will bring lower fees through better scalability, faster deposit times when moving funds to the L2, improved compatibility with the Ethereum mainnet, and major improvements to the node software itself, most notably of which is reducing the rate of data storage growth of a node, and that is about 15 gigabytes per year in savings, which is very important. State management is going to be very important as we go on. The networks are getting huge. All in all, this is a wholesale upgrade for Optimism, bringing the network right back into the ever-escalating battle of L2s competing for user deposits in the Ethereum ecosystem. Even better, with this update they've built the bedrock, literally and figuratively, on which they can incrementally add more powerful features over the next few years, which is going to be really important to stay competitive. By the way, do you want to hear more about important crypto news for this week, including latest alpha and insights into my portfolio moves? If you want to find that, you will find it in the Crypto Over Coffee newsletter, which is a free weekly update on all things crypto without all the hype and hyperbole that you usually find. So you can sign up for free using the link in the description and the pinned comment if you're watching on the YouTube show. So thank you very much in advance, and I think it'll be worth the free subscription. In other news, there have been some rather interesting updates in the landmark Ripple versus SEC case that has been awaiting summary judgment decision by the judge for a while now. One of the key pieces of the defense for Ripple, as it argues XRP is in fact not an unregistered security, would be the materials pertaining to deliberations and discussions ahead of an infamous speech by former SEC Corporation Finance Division Director Bill Heinemann. Now, in this speech, and likely in the deliberations before it, Heinemann stated that Ether, a cryptocurrency at the center of the securities classification debate, is not a security. Of course, if Ether were deemed not to be a security, and XRP were also found to not meet the criteria as well in this court battle, it would be another tool for crypto legal teams in the US to argue the same case for their own token and coin against the SEC's claims. Now, these Heinemann documents, as they're called, were due to be unsealed by court process in early June, but a joint motion was filed by the SEC and Ripple this week to extend the timeline for release to June 13th, a delay of a week. This recent development's rather confounding to me because I don't understand why both parties, in particular Ripple, would agree to extend the timeline for this information to be released unless there was something going on behind the scenes to catalyze this. As clear disclosure, I'm not a lawyer and I don't pretend to be one online, so none of my thoughts on this are backed by legal education. Still, a few speculative thoughts came into my mind when I first read this news. First, are they delaying this to see whether some crypto provision is included in the deal for the debt ceiling in early June? Maybe. Second, I wondered if there's a settlement in the works, and if that settlement would include terms that may invalidate Heineman's statements or internal communications, or even if a settlement's not on the table, maybe the SEC is trying to get more of those Heinemann documents redacted. And why would the SEC want that? Well, if they think they might lose this Ripple case, they would want to position themselves to still have a case against other crypto projects, even including Ethereum in the future. If the Heinemann documents are an integral part of a summary judgment decision in favor of Ripple, saying that XRP is not a security because Ether is not a security, that could be a major issue for the SEC's authority over crypto in general. So it's existential for their position in this regulatory area because if these are non-securities, the SEC is not in a position to be the main regulator, right? So I don't know what the reason is behind the delay in unsealing the materials. It could be nothing, but it could also be an indication that there's interesting things brewing in this case again. So we're going to have to wait and see. And by the way, today's coffee is a really good one from Red Rooster, one of my favorite OG coffee roasters. But anyways, let's stay on the topic of the SEC because it's time for 404 Logic Not Found, a firecracker of a segment on the show where we bring attention to illogical happenings in the crypto space. And as always, if you want to help this show get some attention, please hit like, subscribe, share it with your friends. Whatever you can do really helps and is much appreciated. Now, the SEC has been a topic of conversation on my channel so many times, and today there is more foolishness afoot for me to write about. Recently, the SEC documented what it believes to be 37 cryptocurrencies that are securities under existing securities frameworks like the Howey test, and among those are obvious ones that I agree with, as well as other ones that make absolutely no sense. And that's an issue. More on that in a second. But first, the most illogical part of this move is again that the SEC refuses to give clarity on how existing securities laws apply to crypto, nor how compliance can be facilitated, and yet they're still levying judgment and enforcement action based on interpretive decisions, even ones that go against previous decisions that they've made. Again, enforcement is not a means for regulation nor rulemaking. To make matters worse, there is little to no description of why the tokens listed in this SEC declaration are considered securities, and seemingly no pattern one could even infer among the list of cryptocurrencies that would indicate a common theme or property that makes these securities by law. In the SEC's defense, though, there are obvious Ponzi coins like BitConnect, but then the little sense it makes is ruined by calling stablecoins like UST securities. So how could anyone, in my mind, procuring UST have thought it would go up in value as an investment as a result of some action by the Luna Foundation or other business? It's a stablecoin. It's supposed to be pegged. Is there, I guess, maybe the reason is that Anchor netted yield for UST holders. But even if that's the case, then are dollars a security because I can earn interest using apps and services with it? I mean, UST didn't work out so great, but it went down, not up. And I still don't see where UST, XRP, BitConnect, Algorand, Decentraland, and many of these other tokens have any commonality that makes them all securities. Where are the common rules? This just makes an already muddy picture even muddier, and it's destroying crypto in the US. But maybe that's the whole point, isn't it? If you can't beat crypto in courts or with policy, you would just try and push it out by making it impossible for organized crypto services and products to comply and making the regulatory environment so hostile that it isn't even worth it to operate in the US. Of all the examples I've given so far that illustrate the SEC's illogical, punitive behavior, this is the kicker. They're not protecting investors or the US. They're doing the opposite. The fact that I'm rooting for Ripple and Coinbase, of all companies, is something that I never thought would happen, but here we are. I really do hope these companies win big in court against the SEC and set things right, but it's going to be a major chess match. In other news, this week was one of the most insane weeks I've ever seen in the world of crypto hardware wallets in all my time in this space. And that's because the undisputed leader in hardware wallet sales, Ledger, destroyed the trust that many users had in his business with one controversial feature launch. The Ledger Recover feature that they announced is one that was designed to back up user private keys using a cryptographic scheme called Shamir secret sharing, and it would store the resulting 3 chunks of your private key in encrypted format with 3 custodians so it could be recovered in the event of wallet loss. Of course, self-custody proponents went totally crazy with this, and now other hardware wallet makers have seen a marked bump in social traffic and sales as people flee Ledger and are really angry. However, there was one hardware wallet cold storage solution that caught my eye in this whole thing, and it was a brand new one, and that was called Keyp, Keyp. Keyp both appeals to my technology-minded approach to this space and my 90s kid nostalgia, because it's a cold storage wallet housed in a Game Boy cartridge, so you can turn any Game Boy hardware into a cold storage device. In fact, the entropy or the input to creating your private key is derived, at least in part, from your input playing the little game in the cartridge. And I think this is an incredible idea since it's a cartridge. The firmware of the device cannot be updated, so there's a limited attack surface short of physical access, which is very good. The debate right now is around firmware. That can be a hole. There's a lot that's unknown about this wallet, as it was just recently announced, but I'll work to get my hands on it when it launches and give you a formal review of it, including how usable it is. For now, I'll link the product page in the description if you want to check out more about this wallet. And if you want to know more about the major drama around the Ledger Recover feature that everyone is buzzing about and whether you need to take action if you are a Ledger owner, check out this video that I made, which offers a detailed but easy to understand explainer of everything that you need to know about this without all the drama, histrionics, and hype. So thank you so much for tuning in for this week's episode of Crypto Over Coffee, and I'll see you on the next one in 1 week's time and probably in some videos in between. Thank you so much. Have a great rest of your weekend. Cheers.